Hi, my name is Luis Contreras. I'm a registered investment advisor. And in this video, I'm going to talk about 7 ways that a brokerage account can benefit business owners. Now, in case you were wondering, what is a brokerage account? So a brokerage account is a type of investment account that's not a retirement account. They generally call them sometimes taxable accounts because, investments that are in there could be taxable for the year. Whereas opposed to retirement accounts, they're generally deferred until retirement, where it may be taxable or at the time that you make a distribution from those. So yeah, that's what a brokerage account is generally. And you could open it up generally. Well, generally, excuse me, you open it up with a brokerage company like a Charles Schwab, a Fidelity, a Vanguard, Robinhood. I mean, you name it, whichever one you choose, you can do that. Okay, so let's go over the list. That way we can get going. So number 1 is future use. Future use. So what I mean by this is that a brokerage account allows you to invest funds that you have, that you probably are not going to use for your business, but that you potentially want to use in the future. Like you want to buy a property for your business or reinvest money in your business, but you would like to invest it right now so that it has some gain in the future. Thus, you can multiply your money. That's what I mean by future use. So you don't have it tied in anywhere else, and you can invest it in investments other than putting it just in the bank. So a brokerage account would allow you to do that because you're able to invest it in stocks, bonds, ETFs, mutual funds, potentially, cryptocurrencies and other assets. Excuse me, like that. So future use. Number 2 would be leverage. So in these accounts, you could actually open up what's called an asset, like line of credit or a pledged asset line. Some brokerage company calls it that, or it could have security-backed line of credit, whatever term it is. But basically, you are putting the brokerage account as collateral and are able to take out a loan based off of that account. The great thing about doing that is because it's very similar to other lines of credit, like a HELOC, home equity line of credit, you can access the funds tax-free and are able to use them for a wide variety of things, like reinvest it into your business, debt consolidation or debt refinance, invest it in like real estate or other properties in whichever way you want. But it allows you tax-free access to those funds, which is a great thing. So, and you don't have to sell any of your investments as well. So that's a great tool that you can have just in case you need funds, access to funds. It provides you leverage. So number 3, and this one's kind of self-explanatory, is diversification. So by investing money in an account like this, and outside of your business, you kind of lower your overall risk of just putting all your money into the business. I know if you're barely starting off, you're putting a lot of money into your business to help it grow. I understand that. But if you're more established business, by putting money outside of the business, that also helps you diversify so that not everything is in the business in case you get sued or your business is not doing well and you want to sell it and not going to have that many proceeds from the sale. You didn't put you lower your risk overall by diversifying. So that's another thing. So number 4 would be early retirement ability. So with these accounts, you basically can have access to the funds at any time you want. Whereas traditional retirement accounts, like 401ks, pensions, profit sharing, and things like that, generally you want to wait, or you're supposed to wait until a certain age in order for you to access the funds, or else the IRS, dings you with a 10% penalty, unless you meet certain exclusions for that. But if you don't, then boom, you get that penalty on top of any potential taxation. Whereas in this account, you don't have to worry about no penalty. So you could use the funds whenever you want. And, if you're, let's say, in your mid 40s and you want to use these funds for additional income, you can do that. Because maybe, I don't know, you want to sell the business, you no longer want to do it, or for any other reason. But it just gives you that ability to retire early as well, if that is the case. So yeah, so let's go to number 5. Number 5 is tax benefits. So these brokerage accounts provide you with quite a bit of tax benefits. So let's go with the first one. These accounts allow you to have what's called tax deferral growth of your investments. Meaning, if you bought, like, let's say stock, at Microsoft, let's say you bought it at $100 a share, for example. I don't know what the value of it right now is, and it's now grown to like $1,000 a share or something. You don't pay tax on the growth of the value of the share until you sell it. So the longer you don't sell it, you have that tax deferral. You don't have to recognize any taxes on the gain of your investments. So that's what I mean by tax deferral. You could do the same thing with if you use mutual funds or ETFs. ETFs would probably be the more tax efficient way to use in brokerage accounts. But tax deferral is one of them. Number 2, you could take advantage of the long-term capital gains rates. So if you do invest for long-term, the long-term capital gains rates are right now currently 0, 15, and 20%. So even at the highest, 20%, that's still very low, almost half of the highest federal tax rate, which is right now, 37% in 2026. And that doesn't even include any state taxation. So with state taxes, especially here in California, that could put you over 50%. So with this one, you could take advantage of the long-term capital gains rates. I know that if you do invest in stocks, you could, if you have qualified dividends, those also would be subject to long-term capital gains rates as long as you invest properly for that. So again, it would be at 0, 15, 20%. And right now, if you're a married couple and make like $98,000 or less just in investment income from dividends, qualified dividends, that would put you at the 0% or 0 tax rate for these investments, which is really, really good. Now, let's see here. Another thing too for tax benefits is that if you invest in tax-free bonds, otherwise known as municipal bonds, the interest of those bonds would be tax-free, generally federal tax-free, but you could also invest in certain bonds that not only do you get the interest be federal tax-free, also state tax-free. So if you're here in California like myself, you could potentially not have to pay taxes federally and statewide for the interest on those bonds. Because other bonds that are subject to taxation, the interest generally is taxed as ordinary income. So municipal bonds, does away with that. And then lastly, still on number 5, is that you're able to tax harvest any gains on this account. So what I mean by that is, let's say that you have some investments that you had to liquidate, you had to sell, and you have some gains that you're going to report for the year. Well, what you can do is that you could, if you have other investments that are at a loss, you could sell those investments at a loss to offset the gain. So let's say you had $20,000 of gain and you have other investments that are currently at a loss of $20,000 as well. If you sell those investments at a loss, that would offset the gain. Thus, for the year, you would have a 0 taxable income liability. in these accounts. Now, you have to know what you're doing because it's a little tricky. It's in the industry, it's called tax loss harvesting, but that is a potential that you can do in these accounts, thus kind of shielding you from paying taxes. And at the same time, if those investments that were at a loss, you can still reinvest the proceeds into those investments again, so that you keep it you keep invested in those investments. So it's a pretty good flexibility to get you out of potentially paying taxes on the gain. And number 6 is contributions. So in these accounts, there is no limit on the contributions that you could put into these accounts. You could put in 10,000, a million, a billion, whatever. So it's kind of similar to accounts that you have at a bank. You could put in probably as much as you can at the bank, and I'm sure they're going to want to ask you to put in more. Do you have any more? Bring in more. Same thing in these accounts. There is no limit. You could put in as much as you want. Whereas in retirement accounts, generally there is a limit as to how much you can put in those accounts in order for you to get tax benefits. Whereas in these, there isn't. And then lastly, number 7, almost done here, is balance sheet. So by having funds in an investment account and investing that money, it helps with your overall balance sheet health because it's going to be considered an asset on your balance sheet. So this could help you potentially get more business lending because it'll count as an asset for you. Usually with lenders, they like that. They like to see that you have other assets available. Also, you could get potentially more favorable lending options and tax and interest rates and things like that. So because these are assets, investments are assets for you. Yeah, so that's about it, all 7 that we discussed here. I hope you enjoyed the video. Thank you for watching. If there's somebody that that might benefit from knowing this information, go ahead and share it. Send them a link, or send them to my page, my YouTube page here, so that they can see it and learn more information about this. And of course, if you liked it, hit the like button and subscribe to my channel, as that would greatly help me out a lot. And yeah, and also you can share it in your own social media platforms as well. So again, thank you for watching. Greatly appreciate your attendance. And until the next video, I wish you guys all the best in your financial success, in your financial lives.